In a bold escalation of economic warfare, the U.S. government on 22 October 2025 announced sanctions targeting Rosneft and Lukoil, Russia's two largest oil producers, justifying the move by pointing to Moscow's ongoing war in Ukraine. According to a release from the United States Department of the Treasury, these measures are intended to degrade the Kremlin's energy revenue base and reduce its capacity to sustain military operations. The U.S. sanctions cut off the targeted firms from U.S. banking systems and prevent U.S. persons from dealing with them or their subsidiaries. There is political significance to the timing. President Donald Trump signaled that harsh economic measures have trumped diplomacy by calling off a planned conference with Putin. Moscow did not mince words in its response. President Putin called the sanctions a grave act of hostility, but emphasized that Russia will not back down. The impact that these sanctions seem to be having on China and India, Russia's two biggest energy consumers, makes them very significant. Following the U.S. sanctions, China's key state oil companies, including PetroChina, Sinopec, CNOOC, and Zhenhua Oil, have halted purchases of seaborne Russian crude, according to various sourcing by Reuters. While the pipeline imports from Russia may continue, for example, via the Eastern Siberia Pacific Ocean pipeline to China, the suspension of seaborne imports is a major shift, since much of Russia's discounted crude exports to Asia were seaborne. Reuters estimates suggest China was taking around 1.4 million barrels per day of Russian oil by sea. The newly imposed suspension may involve up to 250,000 barrels per day by Chinese state firms alone in the short term.
There's a total collapse. There's no gasoline anywhere. I've already checked 5 stations. I thought I'd have to walk. I finally found some gas on the way out of town, but there's no 92 octane at all. Some places are only selling with coupons. What is this, the Soviet Union?
Now, regarding the new sanctions, first of all, there is nothing new here. Yes, they are of a serious nature for us, of course, this is understandable. And they will have certain consequences. But still, they will not significantly affect our economic well-being. This, of course, is an attempt to put pressure on Russia, but no self-respecting country and no self-respecting people ever decided anything under pressure. And of course, Russia has such a privilege to feel and consider itself on this list of self-respecting countries and peoples. Of course, this is an unfriendly act towards Russia. This is an obvious thing. And it does not strengthen Russian-American relations, which have just begun to recover. Of course, with such actions, the U.S. administration damages Russian.
At the same time, India's refiners are reportedly preparing to sharply curtail imports from Russia as well. Industry sources told Reuters that major Indian refiners, including Reliance Industries Limited, which has long-term deals with Rosneft and the Indian Oil Corporation's refining arm, are reviewing contracts tied to Rosneft and Lukoil in light of the U.S. sanctions. Since 2022, India has been among the biggest purchasers of cheap Russian seaborne crude worldwide. According to the data, Russia's oil supplies to India may drastically decrease in the upcoming months. Given its history of defying Western attempts to impose energy restrictions and its deep energy ties to Moscow, India's cooperation, or at least acquiescence, to U.S. pressure is noteworthy. First, Russia's oil and gas exports have long been the backbone of its war economy. A significant portion of state monies used to finance military spending and other state expenditures comes from energy earnings. By imposing sanctions on Rosneft and Lukoil, the U.S. specifically aims to cut off these sources of income. Targeting the shadow fleet of tankers and unidentified middlemen that have assisted Russia in evading earlier penalties, the U.S. actions expand on past sanctions initiatives. Second, Russia's main buyers, namely China and India, until now have provided a cushion against Western sanctions by absorbing large flows of discounted Russian crude. China's state refiners buying from Russia helped keep export volumes and revenue at levels that mitigated Western pressure. Likewise, India's heavy imports of Russian crude helped Moscow find a stable market despite European withdrawal from Russian energy supplies. But the current developments suggest that cushion is weakening. Third, when India and China pull back, the impact is twofold. On the one hand, it lowers the amount of Russian crude sold at a discount. On the other hand, it makes it harder for Russia to sustain cash flows through export routes, even through middlemen. Even while Russia might try to locate other buyers, possibly in Latin America, the Middle East, or Africa, The risks associated with logistics, price breaks, shipping, and insurance significantly increase. In fact, traders are already cautioning that as buyers rush to secure non-Russian alternatives, the world's oil markets may experience upward pressure. From the standpoint of the buyer, China and India are having to make tough trade-offs. The possibility of secondary sanctions and more U.S. tariffs for India is increased by its continued large purchases of Russian petroleum. In fact, President Trump recently threatened to impose massive tariffs on India unless it stopped purchasing Russian oil. Meanwhile, China must weigh long-standing strategic alignment with Russia against the risks to its global trading position and exposure to U.S. sanctions pressure. Both countries appear to be recalibrating. According to Reuters, China's state companies are already halting seaborne imports, and India is poised to sharply cut Russian oil imports. The loss of these important customers, or the requirement to sell at steeper discounts or with more intricate shipping and insurance arrangements, poses a danger to Russia's ability to maintain its high military spending by lowering revenue margins. Although the Russian economy does not immediately collapse as a result of this, the strain is greatly increased. But a warning. Analysts and skeptics caution that penalties are by no means a last blow. For instance, one Reuters piece notes that oil markets are still assessing the extent to which buyers will fully comply, and that pessimism is beginning to creep in about whether the U.S. commitments will be sustained and prevent substitution by Russia. Moreover, Russia may attempt countermeasures, deepen discounting, leverage pipeline routes less exposed to sanction risk, or rely on state support to sustain the war economy longer than anticipated. Within Russia, the combination of external sanctions and internal pressures is beginning to generate signs of strain. Russian state media recently reported that 67% of Russians believe that the economy will not improve, indicating severe erosion in public confidence. Note, this figure is based on state-controlled media reporting and should be treated with caution. At the same time, Russia's energy infrastructure has taken hits, from Ukrainian drone attacks to shipping disruption, further complicating production and export logistics. While some specific incidents have been reported, not all claims are independently verifiable. Those are here noted as unconfirmed. The cumulative effect is a tightening noose around the Russian economy, as one analyst put it. Each additional sanction may not immediately collapse the economy, but it makes breathing ever harder. The U.S. in January 2025, Treasury said that it was stepping up sanctions against the oil industry, targeting over 180 ships and dozens of oil traders connected to Russia's shadow fleet. Senior Kremlin officials' remarks on the Russian political front show increased rhetoric, such as the use of phrases like declaration of war to characterize the sanctions, even if they are political pronouncements, and should not be interpreted as actual military declarations. For example, it has been claimed that former President Dmitry Medvedev called the sanctions an act of war by the United States. Again, it is unclear how these raised terms will actually be employed. Other steps, like prohibiting the import of Russian LNG for a number of years and broadening the sanctions lists of boats connected to Russia's oil trade, have been declared by Western nations, notably the European Union. Despite some advances this week, economists caution that unless enforcement is strong, substitution and workarounds may lessen the impact of the events on the global energy market front, which are already altering the dynamics of oil prices. In summary, Russia confronts a three-pronged squeeze. Voters dissatisfied with economic stagnation are more likely to create internal political stress, shipping and insurance risk is higher, and important importers are less willing to absorb its crude. At the same time, India and China are signaling they will no longer act as free import buffers without categorizing their decisions as unequivocal support for sanctions. It is too soon to say the Russian economy is collapsing, but what we are seeing is a sharp escalation of leverage being deployed against Moscow and a pivot in the behavior of its major clients. First, the actual oil flow data. Will we see steep drops in Russian crude exports to China and India? Will substitute buyers emerge, and at what price? A sharp drop in exports without equivalent alternative sales would signal serious strain for Moscow. Second, enforcement. The effectiveness of sanctions depends on how they are applied. The effect will be lessened if shipping, insurance, and financial companies keep secretly facilitating Russian movements. Some independent Chinese refiners may keep purchasing while evaluating risk, according to reports already in existence. Third, how will Russia react politically? Will internal tensions result in changes to the war economy's financing, budget cuts, or internal unrest? Putin has openly reaffirmed his commitment to the war thus far, dismissing the idea that sanctions will divert Russia's course. Lastly, the effects on the global market. If large customers withdraw, there may be a short-term increase in demand for oil from the Middle East, Africa, or Latin America, which would raise prices. analysts are already pointing to potential increases in non-Russian barrel prices. For energy-dependent economies like India, the switch to more expensive suppliers may raise import bills. India's own refiners have reportedly said that replacing Russian barrels with market-priced crude could increase the import bill by under 2% annually, but the transition is expected to be bumpy. In summary, the sanctions announced by the US, the pullback of China and India from Russian crude supply, and the mounting shipping and insurance barriers represent a substantial escalation in pressure on Russia's energy sector. While the Russian economy is not yet collapsing, the framework for sustaining export-driven revenue is clearly under attack. The real question now: can Moscow adapt its model and buyers to maintain revenue streams? Or will the combined pressure force a significant reorientation of its economy and war financing? We'll be watching closely.